All right. Well, aloha and welcome everyone. So our webinar today is how to get the best mortgage rate, hosted by our very own Kurt Nielsen. This is part of our monthly webinar series helping to empower and educate our housing professionals. There will be a link in the chat to sign up for our next 3 sessions. So VA loans are going to be in March, Lava Zone 2 loans in April, and non-QM loans in May. And so we have it on the screen here as far as what's coming up next, and I will drop that link in the chat if you want to sign up for the next ones. And from here, I'll hand it off to Kurt.
Okay, excellent. So I do want to encourage everybody to ask questions. You either unmute and just interrupt me. I like it. That's probably the best way. Or if if you're shy and you just want to put something into the chat, then just put your question into the chat, and hopefully Alex will be watching that and will interrupt me and we'll answer questions as we go along. So, and we really do encourage a lot of questions because, this is, I've been doing this for 23 years and it's easy schmeezy to me, but sometimes we get into acronyms and you may not understand what I'm talking about. So, stop me if you're not understanding what I'm talking about. So I have owned and operated a mortgage brokerage in Hawaii for 23 years. We've closed, I think, over 1.5 billion loans, at least in my career. I have an MBA in finance and a master's of science in economics. So, I do follow the markets. I know how to follow the mortgage-backed securities market. And we're going to get into a little bit of that today, why that's so important that you work with a loan officer that really has the experience, or the company has the information for its loan officers to make good decisions. And that's just what it really comes down to. Because this is an advisory business that I operate in. And if you got a good advisor, you might get a better deal. So, all right. So what determines mortgage rates? We get calls all the time. What's your rate? Well, everybody has a different rate. There isn't one mortgage rate. What you see online is usually based on a very specific borrower profile, property type, occupancy, and loan structure. And they usually give a rate for the perfect loan, a nice big down payment, the best FICO score, primary residence, and that may not apply to your situation. So you really need to get into a conversation and go through the layers that affect what mortgage rate you're going to be offered. So that's what we're going to unpack today, is all of the things that I have to, and Alex has to go through in order to give you a rate that is specific to your situation. And a lot of times I can give you multiple rates and let you choose. And we're going to talk about what that means. So the key drivers for mortgage rates, the number one issue is your credit score in your borrower profile. Are you self-employed? Are you W-2? But certainly your credit history is of the utmost importance. That's right out of the gate. We're going to talk about how you can manage your credit score, how you can improve your credit score. I've seen people within 60 days go from a 640 to a 750, 760. So it is possible to dramatically improve your scores. We're going to show you some things to consider. It's also important the lender that you choose. Each lender is going to have a different rate on that very day. Some lenders are hungry. They're going to sharpen their pencil a little bit on their rates. Other lenders may be overwhelmed, and so they're not going to give the best rate for that day. So the best lender changes every single day, and we're going to talk about how to manage through that. The property type, single family residence, condo, townhome, duplex, they're all going to give you a different rate. The loan program type, a lot of people don't realize there's over 400 loan types available in the market. And I know loan officers that have never done anything more than a conforming 30-year fixed rate loan. I went for a couple of years, I think like 2022, 2023, where I didn't do a single 30-year fixed. We were doing all ARMs, and we're going to talk about why that is. Also, how you structure the transaction, that's going to affect your rate. And I'm going to show you some examples of how we can affect, the cost of your home by structuring a transaction differently than maybe the average loan officer. And then there's the market forces, and mortgage rates can actually change multiple times per day. The question is, when do you lock? When do you float? Well, if you follow the mortgage-backed securities market very closely, you can determine pretty closely, you're not going to be perfect, but you can determine pretty closely when it's time to lock your rate. So let's talk about FICO scores. How do you, if you don't have a good FICO score or you have very limited credit, the most important thing is you need to establish at least 3 active credit lines, and they have to be active for a minimum of 12 months, better if it's 24 months. So for those that don't have credit, begin establishing it. Open up some credit lines, pay on time, and if you have a long history of timely payments on your credit cards or your car loan, then that's going to help raise your FICO score. Avoid closing credit lines. I see so many times when people have bad credit, they start closing all their credit lines. Well, all you're doing is losing your credit history. So you don't want to close credit lines. And the most important thing with credit cards, if you have let's say you have a $10,000 credit limit on your credit card, never charge more than 25% to 30% on that credit card at any time. Even if you pay the card off at the end of the month, if you run it up close to its credit limit, and that gets reported because maybe the credit card company reports on the 21st of every month, then that's going to hurt your credit score dramatically. So never charge more than 25 to 30% on your credit card. If you need more credit than that, then ask the credit card company to goose up your credit limit so that you can always stay within that 25 to 30%. Also, if you don't have good credit or you've got a troubled credit history, you've got to consider hiring a legitimate credit repair service. That might cost you $800 to $1,000, but frankly, it can save you $300 or $400 a month on your mortgage. And I'm going to show you some examples of this. So a legitimate credit repair service doesn't just go in and, let's say you've got some derogatory comments on your credit report. A lot of companies can boost your credit score quickly just by challenging those. Well, if we see that on the credit report, we have to remove those challenges before we can get your score. So that doesn't do any good at all. But these credit companies promote this, and that's not a legitimate way to improve your credit. You can remove inaccurate information. A lot of people have inaccurate information on their credit report, too many aliases, that kind of stuff. Remove outdated items. Sometimes there's things lingering on your credit report that shouldn't be there anymore, and these credit repair companies can get it off. You can also now add rental property payment history. If you've been a renter and you've paid on time, and you can get your landlord to confirm that can be added to your credit report, and that stays in there for good. So that will boost your credit scores. Credit repair companies can also negotiate to remove a derogatory report on your credit report. So for example, let's say you had a credit card on auto pay, and for some reason that auto pay fell off and you were late. Well, if that was the bank that you have the credit card with, then you can argue, hey, listen, you should have called me if the auto pay went off. Maybe you can argue it off. So sometimes they can negotiate the removal of a derogatory. And a lot of times people have duplicates on their credit report. And this is where one of the agencies has left off a number on the account number. And so it shows up as a separate late payment or something like that. So, this takes 3 to 6 months to get through, but it's a good investment if you do have some bad credit that you need to deal with. And the final thing is, and this is a little, uh, kind of a sneaky way to improve your credit scores. But if you get added to somebody else's credit card as a responsible authorized user, like a family member or your spouse, if that card has a long history of timely payments, and again, if the user of that card never charges a whole lot compared to the credit limit, that can dramatically boost your credit scores. So, for example, my daughters, if they're going to go buy a house a couple of months ahead, I would probably add them to all my good credit cards that I've paid on time, and that'll boost their credit scores sometimes 100 to 150 points. And it's legitimate. They can be added to my credit cards. There's nothing illegitimate about that. And it can boost their credit scores quite dramatically. So think about those things. And I'm not a complete expert on credit, but this is what I see in people's credit reports. So really manage your credit. I mean, it's so important. Pay on time. Don't run your credit cards up. So, okay. Any questions? Okay, let's go on to the next one. Well, this kind of shows you the impact of FICO scores. So let's say a person is buying a property at $1.4 million and is putting 25% down. With a 659 FICO, they're going to get a rate of, you can see here, 6.5% with a monthly payment of $66.37. Now, if I just improve my FICO scores a bit to 761, this person's going to get a rate of 5.875% and a payment of $6,211. That's a monthly savings of $426. That's a car loan. It's important. So is it worth spending $800 to $1,000 to permanently improve your FICO score? I think it is. It really can be. Now, if you don't have a lot of derogatories and you just need to add credit lines, then being added to somebody else's credit card is a really quick way of boosting your credit. Okay. So the next thing that's important is the lender that you choose. And frankly, if it were, hold on, I got to do something. If it were me, I would tell you not to choose the lender. That shouldn't be your job. That's something your loan officer should be doing. And there's just too many variables for you if you're not in the business that you should not be shopping lenders. Let your loan officer shop the lender. And so you should always work with the mortgage broker. Banks are only going to sell the products that they have. And that loan officer works for the bank. They don't work for you. They work for the bank. But a mortgage broker works for you. We don't work for any lender. We are independent. There's no incentive for us to use one lender or another because we get paid the same. So your loan officer becomes your consultant and your advisor. And we can go to any lender. So it's important, I think, that everybody use a mortgage broker rather than going direct to a bank or a direct lender. You also need to work with a loan officer that has the financial background and knows how to structure the loan properly. I'm going to show you some examples of loan officers that didn't structure a loan properly, or didn't fit the loan to the person's needs. Once we have all your information, we can shop hundreds of lenders simply with the press of a button. I mean, it's that easy for us. because it's built into our mortgage software. So here's an example of I did a screenshot from my mortgage software system. I inputted all of the client's information, FICO scores, what are they purchasing, a single family residence or a condo, how much are they putting down? So all of that information gets put in, and then I hit a button. And if you can see up here, this scenario brought back 115 lenders that would lend in Hawaii, and based on the criteria that I put into that scenario. So there's no way you can go price 115 lenders. That would take you weeks. What takes me 60 seconds. So in this case, I found that Freedom Mortgage has both a Fannie Mae and a Freddie Mac loan for this client at 5.875% on a 30-year fixed mortgage. And it comes with a small fee of $2,200. Now, that's the best rate in the country for this client from a lender who lends in Hawaii. Now, there are going to be ineligible lenders. Most of the people that are on the ineligible list don't lend in Hawaii. Not everybody lends in Hawaii. So we've got a shop specifically for lenders that lend in Hawaii. So this gives you an idea of what I'm seeing on my screen. And we basically just go right to the top. And that's who we send your loan to. Now, there may be a reason we don't go with that lender. A lot of times I can negotiate. Let's say Provident is pretty close. They're really close. I could go to Provident because they're easier to work with, maybe. And I could go to Provident and say, hey, I'd like to negotiate this rate. If you can beat Freedom, I'll give you the loan. So maybe they make this $2,200 go away, and now I'm negotiating on your behalf to get the best rate. And we do that all the time. You know, we might go to the first 3 or 4 and say, hey, you're really close. Do you have any latitude, to give us the best deal? Because we've got to place this loan. So that's kind of things that we do in the background, is we're also negotiating on your behalf. Okay, any questions so far? All right, Alex, you don't have anything in the chat, do you?
Nope.
Okay. All right, so the next thing is property type. Different property types are going to get different rates. A single family residence that is fully permitted is going to have the best rate. Lenders see that as the lowest risk type of property. Next comes townhomes, duplexes. The rate on those is just slightly higher, maybe 1/8 of a point. And a warrantable condominium is about 1/8 of a point higher. Now, what we mean by warrantable condominiums are condominiums that are approved or will meet the guidelines for Fannie Mae and Freddie Mac. Now, in Hawaii, most condominiums in Hawaii have been dropped by Fannie Mae. And this came after that collapse of that condominium building in Florida. Basically, Fannie Mae does not like any condominium that is showing vacation rental. So a lot of condominiums in Hawaii are not warrantable. So a non-warrantable condominium is going to pay up a rate about 0.625%, a little more than half a point higher in rate than a warrantable condo. So that's important to know. If you're making an offer on a non-warrantable condo, you should know if that condo is non-warrantable. I've seen people actually close on property never realizing it's a non-warrantable condo. And that is going to come back when you go to sell the property. It might come back to haunt you a little bit. Condo hotels. We have a lot of condo hotels in Hawaii. And a lot of lenders are calling virtually any condominium with a high percentage of short-term vacation rentals, they're calling them condo hotels. And again, you're going to pay a higher rate. In addition, you might have to put down a higher down payment, usually 25% to 30%. And manufactured homes, we don't have a lot of those in Hawaii, but you would pay a higher rate for a manufactured home. So again, if you want to get the best possible rate, look for a single family residence. So there's a lot of factors that are going to go into getting the best rate. Okay, now let's talk about loan products, and I could spend 2 days on this. I mean, there are so many loan products in the marketplace. There are loan products where you don't have to show any income. There are loan products that are based on your bank statements. There are loan products that only look at the rental income from the property you're buying. So there's so much out there. But fundamentally, you really need to select a product that fits your plan, fits your family. Okay. Most loan officers focus on the 30-year fixed. And that's great for like a retiree that can't suffer any price sticker shock if rates go up in the future. So that might be their forever home. They're locking in a rate for 30 years. And that's great. I mean, that's perfect for them. But for a lot of people, ARM products will have a much lower rate. Now, an ARM is really a hybrid. It's fixed for 3, 5, 7, or 10 years. So part of it is a fixed rate loan. It's still a 30-year amortization, but at the end of the fixed period, it's going to adjust maybe once, maybe twice a year based on current market conditions. Now, if you're a first-time home buyer, a 7-year ARM is probably the best selection for you because you probably won't be in that home for 7 years. It's your first home. You might be growing your family and later down the road, and you're going to look at getting out of that property. Or if you're it's interim housing. I see a lot of veterans that get relocated in the military for a period of 3 years, and then they're going to buy and sell that house. And so why would they pay a higher rate on a 30-year fix? They're never going to keep that property 30 years. Also, families that intend to grow. If you're newly married, you want to have children. Get into a 7-year ARM or a 10-year ARM or a 5-year ARM, pay a lower rate. And then if you start a family, then you're going to try to buy a bigger home with more bedrooms. Yeah.
We do have a question. What is warrantable versus non-warrantable?
Oh, great question. Okay. So let's just pop back. So right here, a warrantable condominium is a condominium where when the loan closes, the loan can be sold to Fannie Mae and Freddie Mac. They generally have the lowest rates. If it can't be sold, that means the lender has to keep it on their own balance sheet, and that becomes a non-warrantable condominium. There's lots of things that can cause a condominium to be non-warrantable. Again, I mentioned a lot of short-term vacation rental, a low owner occupancy, meaning that most of the units are rentals. Maybe there's litigation. Fannie and Freddie don't like that. Maybe they have low reserves. If there's a maintenance issue, they don't have enough money in the reserves to repair a significant issue. So there's lots of things that can make a condominium non-warrantable, but all that means is those loans are never going to be sold to Fannie Mae and Freddie Mac until the issue is resolved. So you want, if you can, to buy a condominium that is approved by Fannie Mae or Freddie Mac, or can be approved because it meets their guidelines. But again, I would think in Hawaii, more than 50% of all condominiums are non-warrantable according to Fannie Mae. Okay? Okay, so let me give you an example of the difference between a fixed rate and an ARM. So let's say that same example I used before, the person could get a 30-year fixed rate at 5.875% with a payment of $62.11. Well, if they turn to a 5-year ARM, that same loan amount would have a rate of 5.375% and a monthly payment of 58.80. We could save them $331 a month just by giving them a different type of loan. And I frankly believe rates are going to continue to go down. And in 3 or 4 years, you're going to be refinancing anyway. So maybe a 5-year ARM is the most logical choice, especially if you don't think you're going to stay in the property that long, or if you really think that rates are going to come down. Why pay the higher rate? That could be, again, almost $5,000 a year out of your pocket for really nothing. It doesn't give you anything other than the security of a loan that will never change. And a lot of times when the ARM comes up for adjustment, a lot of times the rate's going to go down. So it depends on where the financial markets are at the time. And finally, the loan products that you really want to try to get into would be a government loan. Those are the Federal Housing Administration, FHA, Veterans Administration, if you're military, or the U.S. Department of Agriculture. Virtually every home in Big Island, except for Hilo, is approved for USDA loans, and those rates are dramatically lower. So let's say, going back to this example, what if this person that was buying this property on this 30-year fixed was a veteran? Well, they wouldn't pay 5.875% for a 30-year fixed loan. They would pay 5.375%. So that's a half a point lower. Or let's say they're going to be moving again in a few years. The military is going to move them in 5 years. They could go get a 5-year ARM and only pay 4.75%. So you're probably saving $660 a month if you're a veteran and go for an ARM loan versus a person, just a normal person who gets a 30-year fixed rate loan. So pretty important to really look at the loan product, what fits you the best. And that's really the job of your loan officer is to raise the questions. What are you comfortable with? What's your plan? Do you see yourself in this house in 5 to 7 years or in this loan for 5 to 7 years? Now, remember, a lot of people 5 to 7 years down the road, they have a lot of equity in their property. They want to pull some of that equity out and they refinance anyway, even if they stay in the house. So that 30-year fixed loan didn't do them any good. And I want to make one point that the United States is the only country in the world that offers a 30-year fixed rate loan. And most people think it's just a way for banks to have windfall profits because the average loan, the life of the average loan is only 7 years. Did you know in Canada you have to get your loan readjusted every 5 years? So every 5 years, your loan is going to adjust. There is no 30-year fixed loan in Canada, but they're paying lower interest rates on the whole. So the 30-year fixed, one could argue, is it just the banking industry's way or Fannie Mae and Freddie Mac's way of having a windfall profit. And they poo-poo ARMs because they don't make as much money on them. So that's just the way it is.
And Kurt, for
Yeah.
the third example for an ARM, what was the purchase price and loan amount for those examples?
Oh, I think I used the same one. It was like 1.4 million, I believe, and then 25% down. I believe that's what I did.
Okay, thank you.
Okay. Now, occupancy rate, the occupancy of the property is very important. And this is where we're seeing a lot of mortgage fraud. So a primary residence is going to get the best rate. So if you call the home a primary residence, and you've heard of these politicians in Washington, D.C. or Virginia who buy property in Maryland or, in South Carolina and call it a primary residence, but they can't be a primary residence if they're representing the state of Virginia. And they are, basically committing fraud. And the reason is because if you look at the rate on a primary residence would normally get 5.875%. The second home is a half a point higher, and 6.375%. So that could be several $100s a month more. Same thing with investment property. So the question becomes, and lenders are taking this really seriously. They question whether this is going to be a primary residence or not. Do you work in the area? Do you have a current home that's worth more than the home you're buying? So they're going to look at all this stuff. And we're finding more and more mortgage fraud when it comes to occupancy. And you don't want to fool around with mortgage fraud. I mean, people go to jail for that. And there's quite a few politicians right now who are in trouble over this, and they got caught. In fact, somebody in the Trump administration did serve, I think, 3 years in prison for misstating the occupancy on a mortgage loan. So, okay. So let me give you an example of how a loan officer can hurt you or help you. So here's an example, and this is an example that I had a client come to me after talking to another loan officer. They were buying a property, and I'm just using fake numbers here, but let's say it was $1,350,000, and they only have 10% to put down. So a lazy loan officer would just say, okay, 90% loan, the loan amount will be $1,215,000. You'll put $135,000 down as a down payment. Let's say they have a FICO score of 680. The rate would be 6.375. I just priced that today. The principal and interest payment would be 75.80. Now, if you don't put 20% down, guess what you get to pay? You get to pay mortgage insurance. And basically, mortgage insurance is an insurance policy that you pay for and give to the investor who buys this loan, so that if you default on this loan and they don't get their money back, the insurance company will offer the difference of what they invested and what they got back out. So it's an insurance policy that you pay for. So your total monthly payment with principal and interest and mortgage insurance, I'm not adding tax and insurance right now, but that payment would be $82.38. So if this client came to me and I said, well, let's try something different. You'll get a much better rate if you have a 75% first mortgage, and then we'll back that up with a 15% second mortgage, either a HELOC or a true second. In this case, I'm going to do a home equity line of credit. So the purchase price is $1,350,000. The first mortgage is now almost $200,000 less, $1,012,500. And then I'm going to go to another lender. So it's twice as much work for me, but you're going to see the difference that it's going to make to the client. So I'm going to give them a home equity line of credit of $202,500, same FICO score. The first mortgage now is not 6.375, it's 6.125 because the down payment is bigger. So the first mortgage has a payment of $61.52. The home equity line of credit is an interest-only payment. Right now, I can get them at about 5.875% fixed for 5 years. And this is a 30-year fixed mortgage here. I could do a lot better than that if we did an ARM, but I'm just assuming this first mortgage is a 30-year fix. But the home equity line of credit would be $991 a month. Now there is no mortgage insurance because the first mortgage doesn't need an insurance policy. And the total payment drops from $82.38 to $71.43, and that's a savings of $1,095. Most of that is because we saved the mortgage insurance. There is no mortgage insurance. Now, is this very much fun for me? No, but it is the right thing to do because I have to do two loans instead of one. And a home equity line of credit is just as much work as the first mortgage. But maybe the client's happy and they'll send me a referral someday. So that's what we're hoping for. Let me give you a second example. This is another real world situation that a client came to me after talking to another loan officer. This client lived in North Carolina, wanted to buy a new primary residence on Big Island, but did not want to sell their current residence because they weren't sure they're going to like Hawaii enough. So they're going to keep their current residence and rent it out. And they didn't have any cash for a down payment, but they have a lot of equity in their home in North Carolina. So the loan officer that he talked to first said, okay, we'll do an 80% home new loan on the home you're buying, and that's smart, no mortgage insurance. We'll have you go get a 20% HELOC on your current home in North Carolina to make up the difference. Okay. I mean, that makes all the sense in the world, right? So the purchase price, again, let's say it's 1,350, 80% on the first is $1,080,000 on the first mortgage in Hawaii. The HELOC in North Carolina is $270,000. The first mortgage here might get a rate of 6.125%. Monthly payment is $65.62. The HELOC would be prime plus 1.5, 8.75%. That'll cost them, and this is an interest-only payment, $19.69 a month for a total of, $85.31. Now, when I sat down with this client, I was talking to him. We found out he was a veteran, and the home in North Carolina, he had a VA loan on it. And I looked at the rates and everything, and I said, well, if you didn't have that VA loan on your home in North Carolina, we could do 100% financing here in Hawaii. So what we had him do is go refinance his home in North Carolina. He got about the same rate, for whatever reason, the market was the way the market was. So now it freed him up his certificate of eligibility for the Veterans Administration. So now we could get him 100% financing here in Hawaii. So purchase price of 1,350, VA mortgage of 1,350, no second mortgage, because all we did is refinance, didn't take any money out of the North Carolina home. He got 5.5% on his VA loan, a payment of $765, no second mortgage. So we were able to save him $866 a month. And that's a lot of money. I mean, basically he has the same amount of debt in both scenarios, but by asking a lot of questions and thinking, through the scenarios, we were able to save him almost $900 a month. I mean, that's almost a Porsche monthly payment for a car. So just by structuring it right, again, we saved that person a lot of money. Okay, so you can see, and I could give you lots and lots of examples on structuring, what kind of product to use, how to break up a loan. Maybe they have other property in other places that we can draw from. I mean, there's so many things that we can look at to bring to the table the best scenario for that client. And I always collect all of the mortgage statements if they have multiple properties to see what interest rate they have on their other properties. And if they've got a lot of equity in another home and they've got a bad interest rate, the very first thing you do is, well, let's pull a little money out of that property and lower your rate. So there's lots of things we can do if we just take a step back and spend some time thinking through the best thing for the client. Okay, and just real quickly, I wanted to talk about some other things, rate lock considerations. So a lot of people, when they get a loan, as soon as the loan is submitted, the loan officer will lock that rate. And that rate lock protects you from rate increases. If the rate goes down, you don't get the reduction. So you're locked in, forget about the market. You have no way to go up or down. Also, the rate lock length affects the rate. So if you want to lock for 60 days or 45 days, that costs more than a 30-day lock or a 15-day lock. So a lot of times we'll submit a client's loan, but not lock them yet to see if we can get into a window of only 30 days or 15 days. And that has a lot to do with watching the market. And I'm going to talk about that. Also, if you miss your rate lock, so let's say you've locked it for 30 days and you're not going to close for 40 days, those extensions cost money. So if you don't select the rate lock that is consistent with how much time it's going to take to close a loan, you may end up having to pay more. Also, if you lock your loan and the mortgage rates go down, don't expect you'll be allowed to float down if rates are declining during the loan process after you have locked. You have to have a dramatic reduction in rate before a lender is going to consider allowing you to float down. And the only reason they're going to do that is because they know you're going to move the loan to another lender that is offering the current market rate. That's the only reason they do it. Also, trying to perfectly time your rate lock is very difficult. We have a general idea of where we think the market is going, but every day it bounces around a lot. And so, don't get frustrated that, on one day I could have gotten a little bit better rate or better terms, because, it bounces around multiple times a day. You'll never get it perfect. You'll never do that. But you should work with a loan officer or broker who understands the mortgage-backed securities market. We watch it every day. A lot of loan officers don't know what a mortgage-backed security even is. So let me show you what we do every day. So on my screen, on my computers, I have multiple screens set up in my office. I'm always watching this chart. And this is the mortgage-backed securities market. It's a bond market. And this is basically the Fannie Mae 5% bond where they're packaging mortgages and providing a 5% yield to the investors. Okay? Now, if the price, this is the price, if the price of that bond goes up, the yield or the interest rate goes down. So when the bond market is going up, rates are going down. So look, since December 8th, we've had a pretty good run. It's not perfect. It's up and down, up and down. But overall, we've had a pretty good run of improved rates. And rates have improved about 1% over this time period. Now, look at this chart. We also get warnings when the bond market is going upside down or dropping, meaning rates are popping up. And we actually get a rate lock warning. And if you look at this, every time we get a rate lock warning, what happened? Prices went down, rates went up. Prices went down, rates went up. Sometimes you don't get those warnings, but generally we do. And so, we've got to understand what's affecting the market. So right now I have been floating my clients. So I've got a bunch of clients that probably started sometime in here, and rates have been improving. Last few days it's been kind of stable, but we might get a little bit more, and I'll start locking my clients. And they know that we're floating. So by floating, I'm gaining days, so I don't have to do a 45-day lock. I can do a 30-day lock. That saves them money, and maybe rates are improving. So and we're not perfect at this, and everybody knows that, hey, rates could go down. But if I see a rate lock warning, especially with clients that are getting close to closing, I'm going to lock that rate. And I get about a 30-minute head start before the lenders can reprice. So even though the bond market starts dropping, it takes lenders 30 minutes to an hour to react. So I get a heads up. I've got 30 to 60 minutes to lock rates. and I do that as a service for my clients. So, okay. Anything else, Alex? Okay. So just a couple last slides, just mistakes that can cost you thousands of dollars. Shopping rates on your own, there you just can't do it. There's too many variables. And frankly, every time you make a call to a loan officer, they generally don't ask enough questions to get the right rate quote up front. So they may be giving you a false rate quote and you're relying on that. Then in the middle of the transaction, we find out the condo's not warrantable. He quoted you a warrantable condo. Well, local lenders in Hawaii, they're generally going to know if that condo is warrantable or non-warrantable. But if you go to Rock a Mortgage or some buddy in Chicago that's sitting behind a call center, they don't know anything about the condominium that you're buying. Also, just kind of ignoring total cost over time, like mortgage insurance. Yeah, I paid. I'm getting a 30-year fixed rate. I could have gotten a 7-year ARM. I mean, when you start adding up the dollars, it's a lot of money. Another thing we see clients doing is opening new credit mid-transaction. Boy, that can hurt us. So you don't go out and buy a new car in the middle of your mortgage transaction, choosing the wrong product for your personal situation. I'm only going to be here 5 years. I'm going to be out of here in 5 years because the military is going to move me. Why are you paying a 30-year fixed rate product? Makes no sense. It's kind of like getting heated seats and you live in Waikiki, on your car. So don't buy something you're not going to use. I've seen clients, again, we mentioned this before, buying a non-warrantable condo and they didn't even know it. And one, it affected their rate. Two, it affects the way they're going to resell it. So if you go to resell it. And the final one, and this is the most important one, is just waiting too long to improve credit before applying. You got to be at least 3 to 6 months ahead on credit repair or just knowing your credit and what steps you can take maybe to bump it up a few extra points. And there are certain break points. Like if you have a 739 FICO or a 741, there's a price break on the loan rate. So only 2 points in a FICO score can make a dramatic difference. And so loan officers know what those break points are. So they're usually at 660, 680, 720, 740, and 760. So if you're close to getting over one of those break points, we can do things to help you get over that.
Hey, Kurt, we do have a question. If you could give more examples of a wrong quote up front.
Yeah. For example, like the one loan officer didn't ask if the client was a veteran. He didn't offer that up because he knew he already had a VA loan and he knew he couldn't get a second one, so he never offered the information. The loan officer never asked the question. The reason I saw it is I got a copy of the mortgage statement and I could see it was a VA loan. Again, the loan officer not knowing the property type. The quoting, I had a client recently that was turned down a loan like 10 days before closing because they found out the condominium had timeshare in it. And they were trying to do a conforming loan. There's no way you're going to get a warrantable conforming loan on a project with timeshare. So they don't know the project. They don't ask enough questions. How long have you been in self-employed? Did you change jobs? Let's say you're a commission person and you changed jobs recently. You usually need a 2-year history. So there's hundreds of things that can affect your loan and your rate quote that if a loan officer isn't asking enough questions, they're going to misquote you. And that's that. And generally, it's going to be some of the big things like the property type, knowing whether it's a condominium, a condotel, non-warrantable, those kinds of things. Also, lava zones, that's a big one. Another one would be unpermitted structures on the property. That could give you a bad quote. Um, there's property problems, dilapidated, deferred maintenance. So, God, there's so many variables. Um, but most lenders and LOs will quote a vanilla deal, thinking that everything is perfect. And then they start opening the closet and all these skeletons start falling out. And all of a sudden they can't deliver the rate or the loan amount that they had promised. And usually that comes up, 10 or 15 days before closing, and you don't have time to react. I mean, then you got to swallow a bad loan. I don't know. It happens all the time. So that's a good question. It's just the more information the loan officer gets, the better chance they're going to give a good quote. And I always look at making sure they know everything about the property, making sure they know everything about your employment history, because employment history has a big effect whether you get tips, whether you get commission, you get bonuses, stock options. I mean, there's so many things that go into the income side of things. And then a lot of times loan officers won't even read the credit report. They look at your credit score, they see you've got a 700 FICO score, but lo and behold, there was a mortgage late 10 months ago. You're not going to get a loan. So just reading the credit report, a lot of loan officers don't do that. That's sad, but it's what happens. Okay. So just in closing, you do have more influence over your rate than you think. Planning, preparing well ahead of time, especially on your credit profile, can dramatically affect your rate. Structuring your loan officer is often more important than shopping the rate or the lender. Having a good loan officer can go a long way, than if you're just out shopping rates. Also, understanding the mortgage-backed securities market, that's important because we can. I have a client that I just locked this week, and we've been waiting, gosh, 2 months to lock his rates because he wanted rate, and he wasn't going to close it. We didn't get it, and luckily enough, the market improved enough where he got what he wanted. But that's just watching the market. And then matching the product type to your needs. There's no reason to buy a 30-year fixed mortgage if there's no chance you're going to have that loan 7 years from now. Maybe you're going to run into an inheritance, you're going to pay the darn thing off. Who knows? But matching the product type is very important. Okay, I think that's it. I'll just open it up to any other questions people might have. Boy, it's deadly silent. Okay.
Mahalo, Kurt and Alex. Yeah, it was a really good webinar. I learned a lot. I was just wondering if you have any predictions for where rates are headed over the next, I don't know, 3 to 6 months.
I think short term it's tough. We're going to have a change in the Federal Reserve, the chairman. Um, you know, he is looking what we call a little more dovish, or looking more to lower rates than Chairman Powell. So the other issue is, I think Donald Trump administration is focused, very focused, along with Bissett, the Secretary of the Treasury, of figuring out ways to lower mortgage rates to make homes more affordable. That's probably one of their number one priorities for the next 3 years. They've solved a lot of other things that they had promised, but this is one area that they're going to focus on. So I'll give you an example. Trump has asked Fannie Mae and Freddie Mac to buy $400 billion of their own mortgages. So they have a lot of money sitting on their balance sheet. And if they go into the market and start buying mortgage-backed securities, that raises the demand, which raises the price, and that lowers the rate. So that's going to have a big effect. Bassett has some other strategies in terms of going in and buying shorter term treasuries and I mean selling shorter term treasuries rather than longer term treasuries. So again, that could put pressure on the 10-year treasury of going down. So they're looking at lots of different ways. They do have certain tools that they can use to try and drive interest rates down. And a lot of people don't think that if the economy starts revving up with all this money that's being invested into the United States, that interest rates will go up, but that isn't necessarily the truth. You can have low rates in a hot economy, but that means you need a big money supply. And that's where I think the Treasury Secretary Bassett, he's a brilliant man. I mean, he is brilliant. And I think just the fact that there's so much attention on bringing rates down, we know we've got inflation in hand, so that shouldn't be an issue anymore. And I think the Federal Reserve, they have some things they can do to lower mortgage rates. One of them is they can also go into the market and buy mortgage-backed securities. They've actually been selling mortgage-backed securities, so it's been the reverse. But I think over the next 3 years, if you take a little bit longer term view, again, I think short term is hard to predict, but I think over the next 3 years, we will have a 30-year fix that's solidly in the 5% range, maybe 5.5 to 5.75%. And I think we're going to have ARMs in the high fours. So once you are promoting rates in the high fours, there are going to be a lot of people jumping off the sidelines buying homes. And hopefully that'll spark demand. I mean, demand is already going up right now. We're seeing a lot more activity on home buyers just in the last 30 days, 45 days. So.
Awesome. Thank you for that answer. Yeah, no, that's what I've been seeing as well. So, well, fingers crossed it keeps coming down.
Yeah. Yeah. They bounce around and there's a lot going on in the world right now, with wars and things like that. So that's why it's so hard in the short term. But I think in the long term, certainly by the end of the year, we could, see another half a point drop in rates, maybe that much. So.
Awesome. Thank you. I did have
Okay.
a second question kind of on that same wavelength. I've heard whispers of this administration wanting to introduce maybe new programs for first-time homeowners. Have you heard anything that there's like new loan programs coming out? Because as you said, there's hundreds to choose from. Are they adding any more to the mix?
Yeah, the suggestion they made is a dumb one. They talk about a 40-year fixed rate mortgage. And to me, that just adds insult to injury. The 30-year fixed is, I think, a scam, in my personal opinion, because you're paying a higher rate for a loan most people don't keep for that long. And now we're going to go to a 40-year. Well, their idea is that, well, if it's a 40-year mortgage, the payment will be lower so you can afford a more expensive home. My opinion is you're paying a higher rate. Why not just downsize your expectations on the size of the home and maybe get into a 7-year ARM, which will do two things. It'll get you into it. Maybe you do buy a little bit smaller home, but get a rate and a mortgage product that best fits your needs. We got to do more of that. And again, most countries don't even offer the 30-year fix. So, the only way you can really help first-time home buyers, because we can do 100% financing to everybody. There's 100% financing for everybody. So that's not the issue. Down payment is not the issue. Affordability is the issue. And there's two things that are going to affect affordability. One is the number of homes that we build. So the Trump administration, I think, has really got to start focusing on how to inspire home builders. And maybe there's tax incentives, maybe there's, I don't know, investment tax credits. There could be things that they do to inspire home builders, and that would bring the inventory up and the sales price down. Secondly, different promoting more efficient home building systems. And, it seems like, the county permitting and all of this is always against anything new. I'm looking at building a home and I'm going through some pretty radical changes in the way the home is going to get built because we want to remove a lot of on-site labor. So that's a second thing that the government could do is really encourage more efficient building systems to get a home erected and maybe a better built home because we don't build very good homes anymore. And then the third way is just getting rates further down. I mean, that certainly affects home affordability. But for most of the country's history, mortgage rates have been in the high 6-7% range. It's just that when rates went really low, people started expecting that they could buy a much bigger home than they normally would. So their appetite got huge. And so everybody wants a 4-bedroom home or whatever it is, where, years and years ago, you were buying a 950 square foot home and you were happy to do so. And then maybe add on to it later on your own. But, so there's a lot of dynamics into making homes more affordable for first-time home buyers. But, we all know that kids are staying with their parents longer and longer, into their 30s now, and not leaving the nest. And that I think that's an important thing to encourage these younger people to go out and become homeowners. Because if you think about it, most Americans make most of their net worth from home ownership. So most wealth in this country comes from real estate. And there is no question, if you own $1 million house in Hawaii and the values generally go up about 4.9% per year, and they have done that for 70 years, on average for 70 years. So let's call it 5%, you're making an extra $50,000 a year tax-free in wealth. It doesn't take very many years of owning $1 million home before you're sitting on your retirement. And what if you own 2 homes? So home ownership is critical. And but I do believe that they are going to work from several different areas to improve home affordability. I do believe that. And we'll see. I know I just came back from the International Builders Show in Orlando on Tuesday and Wednesday, and there are so many companies out there that are building a better home at a lot lower cost. And so a lot of it's being done in factories, prefabricating wall panels, and there's so many neat ideas going on right now. So I see a lot of hope that home construction costs will come down, and that'll bring, the price of homes down. Yeah.
Awesome. Mahalo. Couldn't agree more.
Okay. Well, if there's no more questions, I'll bid adieu, and we'll look forward to the next webinar, which is going to be about VA loans. So if you know any military people in your family or friends, and they want to know more about VA loans, we'll be doing a VA loan in the next month. So, okay. Thank you, everybody.
Thanks, everyone.
Thank you. Thank you.